In this week's video, we'll review the hard evidence and ask the question, are the stock bulls missing something? We'll shift gears to the charts here shortly. We'll look at S&P 500, Dow, NASDAQ, small caps, provide a fractal update. We'll look at momentum from both a weekly and monthly perspective. What are materials telling us? What have they been telling us? We'll look at some risk on versus risk off charts and compare their looks in 2011 and 2012 during weak periods to their present day look. We'll check in on foreign stocks and revisit the question, could we still be early in the bullish trend? Before we get into the video, we've got some new charts that are not covered in the video that you can find in this post. You can find it either on our website, Financial Sense, or Seeking Alpha. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. We'll kick off this week's video from a chart perspective with a monthly chart of the S&P 500. These are moving averages. In red and blue, they help us discern between volatility to ignore and volatility that needs to be respected and requires defensive action. Bullish look, price above both moving averages, slopes up, blue above red. This is a bearish moving average crossover, telling us there's a change in trend from a probabilistic perspective. After the bearish moving average crossover, the probability of bad things happening increase. This is your dot-com bust. After a bullish moving average crossover, the probability has increased for good things to happen. Bearish cross, bad things happen. Financial crisis, bullish cross. For the most part, good things have happened. You can see the present day look is and has been for some time bullish. We have price in black above the blue and the red moving average, and the slopes of both are up. Point of starting with this, the market model uses observable evidence like this. Every chart we look at and every question we ask, the model asks literally hundreds of questions and does hundreds of mathematical calculations based upon observable evidence and probabilities. For example, we can observe a bearish moving average crossover here before the bear market really kicks into high gear. We can observe a bullish moving average crossover before the bull market kicks into high gear. With central banks printing money all over the globe, at some point we'll have another crisis that looks like this, where the stock market lost over 50%, and looks like this, where the stock market lost over 50%. How do we prepare for that? We prepare for that by monitoring observable evidence, which allows us to manage risk. The CCM market model started buying and redeploying cash intraday on October 10th. The stock market made its final low on October 9th. Intraday, the model was for the most part fully invested by October 18th. The S&P 500 has gained 158 points since the October 9 low. The model will stay in stocks as long as the market allows by reviewing observable evidence and answering unbiased and binary questions. There may be a misnomer that the CCM market model must trade a lot. That's not true. You must hold positions to make money. The market model has made only 3 trades in the last 5 weeks. Not everything we tweet and show on Twitter or in these videos is used in the CCM market model. This would be one example. These are divergences that we'll be looking at. The reason why we don't use divergences, they're very, very difficult to quantify mathematically, and there's a lot of subjectivity involved. However, they can be helpful. This is a monthly chart of the S&P 500. This is monthly momentum measured by MACD. You can see as price here was rising in 1998 and 1999, a momentum divergence was forming. Price is rising above and the slope of this line is going down. Same thing late in this bull market. The stock market makes a higher high in this area here, and momentum starts to diverge, foreshadowing this drop. We recently had this bullish breakout out of a 13-year consolidation period that we've been talking about for several weeks or months. The breakout, instead of being accompanied by a bearish divergence or non-confirmation from momentum, has a bullish confirmation. Momentum here looks nothing like this period here or this period here, where weakness in the stock market followed. Can observable evidence help us? Yes, especially from a probabilistic perspective. Last week we showed this chart, and we've shown this chart on Twitter for 2 or 3 weeks. This is a weekly chart of the Dow Jones Industrial Average. This is our bullish MACD cross, telling us that momentum is bullish from a probabilistic perspective. After the cross, Dow gained for several weeks, bullish cross. Dow gained for several months. Last week we had the bullish cross. Did it help? Yes, it helped. The Dow was up 103 points this week. As we mentioned earlier, the model asks hundreds of questions, some of them relatively easy. One of them is the slope of the 50-day moving average on the Dow Jones Industrial Average positive? Yes or no? No bias can creep into that answer. It's a mathematical answer based upon math and figures. We tweeted this chart in October saying that the probability of good things happening had increased when the 50-day moving average turned up. It turned up here. Since this point here, the Dow Jones Industrial Average has tacked on 600 points. This is a weekly chart of the S&P 500 we've looked at in the past. Good things tend to happen when weekly momentum, Williams percent R, is above -20. You can see the stock market advances above. Good things happen. The probability of bad things happening increases when you drop out of overbought. Bad things happen, drop out. Bad things happen, drop out. Bad things happen. You can see in the present day, this is checking positive boxes with momentum well above -20. Stock market bears would like to see momentum close below -20 in a manner like this. How do we use it? As long as it's above -20, it checks positive boxes in the CCM market model. This is a chart we've shown several times and several weeks ago. We used it to say the present day 2013 looked a lot better than 2011 or 2012. The meat of this chart here is the IYM ETF, or materials. It's very, very similar to XLB. The S&P 500 is shown up here in isolation for reference purposes only. Point of the exercise. 2011, when the stock market was consolidating and going sideways, there was a bearish divergence with IYM, which is economically sensitive, which helped foreshadow this waterfall decline in the S&P 500. 2012, the stock market is rising and then consolidating. Materials, bearish divergence, foreshadowed this plunge in 2012. Similar situation here. Market's weak. Materials are weak. Look at the slope here, and the slope here, and the slope here. Compare that to the slopes in 2013 that told us to keep an open mind about a rally off of the October 9 low that might exceed expectations. Over the past 6 weeks, there's been a lot of buzz on Twitter and in the financial press and media that small caps were waving all types of yellow flags telling us to be careful with the stock market. This is IWM, this is small caps. In the meat of the chart here, the S&P 500 is shown for reference purposes here on top. Similar situation to the chart that we just looked at with materials. You can see small caps moved sideways for 5 months. This point here is identical to this point here, and it helped foreshadow this waterfall decline in the S&P 500 index. This point here is identical to this point here. Small caps were waving a yellow flag for 3 months here prior to this sharp drop in the S&P 500 index in 2012. 5 months here, 5 months here, 3 months here, 3 months here. You can see small caps were not waving yellow flags in recent months and recent weeks. This is a healthy trend that made a higher high. Is it possible that small cap momentum is waning and eventually we'll get a reversal? Sure, it's possible, but price has not confirmed that yet. If anything, the bullish trend was confirmed with a new weekly closing high on the IWM ETF. It's another chart, or risk-on, risk-off ratio. In this case, it's been very, very helpful in terms of participating in the gains off of the October 9 low. This is risk-on stocks, SPY, relative to the aggregate bond market ETF, AGG. When the ratio is rising, stocks are in greater demand relative to bonds. When it's falling, bonds are in greater demand relative to stocks. This is what risk-on looks like. This is what risk-off looks like. Similar to the previous two charts, this divergence here in the ratio was telling us that demand for bonds was increasing as the stock market moved sideways here and helped foreshadow this waterfall decline. This is the slope of the S&P 500. This is the slope of the ratio. Here you can see the ratio rolled over and helped warn us about this decline. Rolled over here, stocks declined again in 2012. In recent months and weeks, the ratio has told us to be patient. There's been no bearish moving average crossover that was sustained in any way here. And rather than the ratio making lower highs and lower lows, lower highs and lower lows, lower highs and lower lows, it's been making higher highs and higher lows, higher highs, higher lows, and made another weekly closing higher high this week. How do we use it? As long as it maintains the bullish look, it checks bullish boxes in the CCM market model. It doesn't predict the future, so we'll head into next week with a flexible and open mind. Just a quick update to our Fractal video. Don't want to spend a lot of time here, but if you've not seen it, the October 19th video talks about fractals, and it ties this chart into the 13-year bullish breakout. Still very, very relevant if you want to find it on the Shavako Capital channel. We're still above the blue box. We hypothesized, 6 weeks ago that this was a bullish breakout here. And the S&P 500 is now gained for 1, 2, 3, 4, 5 weeks. As long as we stay above this blue dotted line, it leans bullish from a probabilistic perspective, just as it did here, here, and here. This is the longer term chart we just referenced. It too is described in detail in that October 19th video. You can see we remain above the blue box. This is a weekly risk off relative to risk on chart. TLT, longer term treasuries relative to the S&P 500. Demand for bonds tends to increase when the S&P 500 here is weak. Demand for bonds picks up. Stock market is weak. This has been very, very helpful in recent weeks. This is what risk off looks like. It has not taken on that look, and the stock market has continued to march higher. Now we're looking at a weekly risk off relative to risk on ratio. In this case, it's TLT, long-term treasuries relative to EFA. It helps us answer the question, would I rather be in bonds? Would I rather be in foreign stocks? This is what I'd rather be in bonds looks like when the ratio is rising, and this is what I'd rather be in foreign stocks looks like. And you can see the answer has been, in the last few weeks, I'd rather be in foreign stocks. This is a monthly chart of the NYSE Composite Index, which is a broader stock index than both the Dow Jones Industrial Average or the S&P 500. We're just revisiting a chart that we described in detail in our November 8th video. This is still relevant if you want to watch that video. The black line for ADX is still rising, which supports the long-term bullish case for stocks. There's no such thing as a perfect advance in the stock market, but for the most part, the answer to the question is no. It does not appear that the bulls are missing something. Things can change quickly, and they may change quickly. It's extremely important that we head into next week with a flexible and open mind. We'll remain with the bullish trends as long as they're bullish. When the market begins to shift, we have to shift with it. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.